So I wanted to record a video on the aggregation analysis as it relates to the employee retention credit. And so the aggregation analysis is one of the areas that is one of the most confused and oftentimes overlooked portion of claiming the ERC. What the aggregation analysis says at a very high level, if there's an owner who owns multiple businesses and they meet certain thresholds, then those multiple businesses, even though they're independent trades and businesses, need to be rolled up into one businesses for the purposes of the employee retention credit. And that could have significant implications because you're looking at a gross receipts test, which now you're looking at multiple entities as opposed to individual entities. And you're looking at partial suspension rules where you're looking at multiple entities versus individual entities. In different scenarios, it could either be a positive or negative outcome for a taxpayer. And it's something that's oftentimes completely overlooked. I wanted to go through the aggregation analysis because it's very complex. And you just Google aggregation analysis IRS and you will see there's a lot of articles, a lot of words about how to perform an analysis. And so I wanted to go through and look at the IRS documents that are in public domain and just provide some high-level oversight on how to think about aggregation analysis so you know you're not inadvertently claiming the ERC when you're not supposed to. Or conversely, we've even seen folks who were eligible for additional funds due to the aggregation rules that they were unaware of. So I'm going to go ahead and share my screen now. Here are the FAQs regarding the aggregation rules under section 448. So when you actually read through notice 2021-20, they talk about the aggregation analysis and they talk specifically about the rules 448. So this is the same section of the tax code that's referenced in notice 2021-20 that we're discussing here. Now, these FAQs were drafted a few years back in relation to section 163, the small business exemption. And this 163 is completely unrelated to the ERC, but basically 163 is a different method of accounting you have to perform based off the size of your gross receipts. These FAQs are drafted. Well, how do we know which companies do we include in those gross receipts? So this section 448 is very, very important for the ERC. So at a very high level, the simplest way to think about this is aggregation rules are there is they're combining the gross receipts of multiple taxpayers as a single employer. If there's multiple businesses, multiple taxpayers, but you might combine these businesses into one single control group based off the ownership of the different entities. So I'm going to walk through the different types of control groups that you want to be thinking about. And so effectively, there's what's called a parent subsidiary control group, and there's what's called a brother sister control group. Let's start with the parent subsidiary control group. So the parent subsidiary is pretty straightforward. It's the type of control group that I think most people are generally familiar with, which is you have a parent corporation, and that parent corporation owns more than 50% of the total voting power of another corporation. So one corporation has a majority ownership of another one. Pretty straightforward, relatively, speaking. And so most people would kind of inherently get that. Well, if my business owns 51% of other business, and effectively I'm that other business, even though I have other shareholders, I control it, right? So this is applicable just to corporation. And so you'd see here, there's an example here where we have a parent corporation, and the parent corporation's corporation P owns 80% of T, right? And then T owns 80% of X. And I know IRS examples are always kind of a little esoteric, but you could see here because the parent corporation owns 80% of T, it is the controlling member of T. And because T owns 80% of X, T is the controlling member of X. And because P is controlling T, P controls all of them. So hopefully that's pretty clear there. But effectively, because the corporations are owning more than 50% of each, then all the ownership flows up to that P and is considered aggregated for the purposes of this analysis. Now, the more common one is a little bit more confusing though, which is this brother-sister control group. And so this brother-sister control group has, and this example here is for corporations, but when you read through the rest of this document, it has nearly identical rules for corporations, partnership, trust, whatnot. There's kind of this two-step analysis. So one, 80% ownership requirement, and then two, there's an identical ownership requirement. So step one is the 80% ownership requirement. Do 5 or fewer people who are individuals, estates, trust, right? So basically think about the beneficial owner. Are there 5 or fewer people who own at least 80% of the entity? So that's number one. And then two, there's the identical ownership. Is that do the same 5 or few persons, to the extent that they're identical, own more than 50% of the total? So what this means is one, we have to look at do the same 5 or fewer people own at least 80% of the entity? If yes, then we have to look at do the identical people own at least 51%, more than 50%, so 50.1 or greater of the total amount. And if that's the case, then these entities are combined. So let's give an example here because it's a little esoteric. So let's look at an individual. So we have individual A that owns 55% of corporation P, 51% of W, 55% of X, 55% of Y, and 55% of Z. This individual A, that's their breakdown. Now, for the rest of corporations, we have this individual B, who owns 45% of P, 49% of W, and then none of the other companies. And then we have C, D, and E, right? So then person C owns 45% of company X, person D owns 45% of company Y, and person E owns 45% of company Z. Why does all this matter? Well, so effectively what we're doing here is what entities of all these corporations are considered to be one. For the analysis of all five, first we look at the identical ownership requirement. The identical ownership requirement of all five companies is met because individual A owns at least 51% of all the companies, right? So you can see he owns 51%, or he or she owns 51% of W and 55% of the rest. So the identical person owns the majority control. So the identical majority owner is there. However, the question is, does the same five people own at least 80% of all of the businesses? And the answer here is no. The same five people do not own 80% of all five businesses, because you have two people who own P and W, and you have two people who own P and X, they're different people, and two people own P and Y, and they're different people, and two people own P and Z, and they're different people. And because C, D, and E are all different people, C, D, and E are not the same five people, and thus are excluded. X, Y, and Z are excluded from this identical ownership situation. You can see here that there's no identical ownership here. The same five people don't own these companies. But that leaves us with A and B. A and B does have the 51% majority ownership, and the same five or few people own both companies when we only look at A and B, right? Because A and B own P and W. This is very, very important. And so you can go through here and you can read through the rest of this document. It's a pretty lengthy document. But what does that mean here? Well, for the purposes of the ERC, what it means is if, let's say, and there's other rules, right? So, let's say there's a husband and wife, and the husband and wife are considered to be rolled up spouses and grandchildren and all that sort of stuff. But let's say you have two partners, and partner A runs a restaurant, and partner B runs a grocery store. And partner A, that restaurant was highly affected, and partner B, the grocery store, was not affected at all. Well, based off the situation here, the restaurant and the grocery store would be aggregated. They would be rolled together. And so now the restaurant and the grocery store we looked at as a single entity, and you would look at the gross receipts together, and you would look at the partial suspension together as relates to both entities. And depending on the individual facts of each individual business, you may see one set of qualifications that be applied to the other one, even though they're separate businesses. But because the ownership structure is now aggregated, certain facts are transferred over to those new entities. It's kind of a complex topic, but it's one that's very important nonetheless. So if you are an owner of multiple entities and you have partners in multiple different entities, you may want to closely look at your aggregation analysis to ensure you're taking into consideration all the appropriate facts and all the appropriate situations to establish the proper qualifications for the purpose of the ERC. Hope this is helpful. If you have any questions at all about aggregation analysis or anything else, feel free to give me a shout.